Greetings and welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners re-domesticate out of volatile legal and tax environments like California to more predictable pro-entrepreneurship, pro-growth jurisdictions. Today, we are reviewing a recent opinion piece by Dr. Joshua Raw and Dr. Benjamin Jaros of the Stanford University Hoover Institute, published in the New York Times on July 5th, entitled "It Failed in France, It Would Be a Disaster in California," describing the forthcoming wealth tax, which is on the ballot this November in the formerly Golden State. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Now, in 1990, 12 industrialized countries levied a wealth tax. And by 2025, that's last year, 9 had repealed their wealth tax. Denmark repealed it, Sweden repealed it, Germany repealed it, the Netherlands repealed it, even France repealed it. These countries discovered 3 things. Wealth taxes are difficult to administer, wealthy people leave, obviously, and the tax raises far less revenue than projected. France abolished its wealth tax in 2018 after an estimated 200 billion euros left the country over 2 decades. The tax generated an annual budget shortfall of 7 billion euros. It cost France more than it collected. Stanford economists Joshua Raw and Benjamin Jaros published an analysis in the New York Times on July 5th, applying the French data to California's forthcoming ballot measure. Their findings: the proposed 5% wealth tax would raise approximately $40 billion, not the eye-popping $100 billion its backers claim. The reason for the gap, according to their opinion piece, is that 30% of California's billionaire wealth tax base departed the state before the December 31st, 2025 residency deadline, as I have reported in earlier presentations on this podcast. The tax applies to billionaires living in California as of that date. The billionaires who left prior to that date are not subject to it, and they took their wealth, their income tax base, and future capital gains with them. The authors stated plainly, all of the things that happened in France would be happening in California, and the consequences could be worse. Moving out of a state is even easier than relocating to a new country. The friction is just lower. The tax savings are immediate. And the billionaires who left did not just remove their assets from the wealth tax base, they removed a stream of income tax revenue that would have continued indefinitely at California's eye-wateringly high 13.3% top state marginal rate. The wealth tax does not replace the income tax revenue that leaves with the taxpayer. It merely accelerates the departure that eliminates both. The opposition to this ballot measure is not limited to conservatives or libertarians or business groups. Planned Parenthood affiliates of California opposes it. The California Teachers Association opposes it. Governor Gavin Newsom, who I will say has amazing hair, that's what I can say about Gavin Newsom, he opposes it. The co-author of the ballot measure, Berkeley professor Emmanuel Saez, has stated on camera that the tax will not be a one-time event. He is on the record as saying that. Congressman Ro Khanna, as we reported in our earlier episode, stated last week that the threshold should drop from 1 billion with a B to 50 million with an M. And it probably won't stop there. That's just my guess. The federal version of the proposal includes a 40% exit tax on net worth above $50 million and some very interesting IRS audit provisions. For business owners in California who have not yet acted, the data from France and the data from Stanford's analysis of California point to the same conclusion. The tax will not raise what its backers promise. The people it targets will leave, and actually already have left in many cases, and the income tax revenue they were paying will evaporate. Then the threshold will drop. It has already dropped from 1 billion to 50 million in the federal proposal. The pattern from Europe is that wealth taxes remain limited to the top tier until they are repealed for underperformance. And the ones that survive, so there is a definite survivorship bias in effect, do so by reaching the middle class. As I explained in yesterday's episode of Legal Bites, one country in Europe has a wealth tax on the books that taxes those earning about $169,000 per year, adjusted, of course, for the conversion ratio. Now, with all of that in mind, redomestication is the lesser known legal mechanism that transfers the business entity. A change of personal residency and a reduction or cessation of business operations in California is the mechanism that severs tax nexus. Both must happen. 30% of the wealth tax base left before the residency deadline. France tried this for 2 decades and repealed it after losing money hand over fist. The ballot measure goes to California voters in November. If you are planning to redomesticate, the time to do so is before, not after. Now, as I said, with this context in mind, redomestication is the lesser known legal process of transferring a company's state of domicile to a new state without dissolving it, without creating a new entity, and without triggering federal income tax, but only when performed with the requisite formalities required by the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of both the destination and departing states. The company retains its existing federal employer identification number, contracts, credit history, and bank accounts. There is no operational or financial disruption when this is performed by a qualified professional. I have successfully completed redomestications from all 50 states and for limited liability companies, partnerships, sub-S corporations, and sub-C corporations. And knocking on wood, we have a 100% success rate to date. Foreign entity registration is not the same thing as redomestication, because foreign entity registration, also referred to as foreign qualification, does not change the company's state of domicile. It does the opposite by keeping the entity in the former state indefinitely and merely adding a second layer of compliance and tax obligations in the new jurisdiction. Meanwhile, a traditional merger, which is also not the same thing as redomestication, creates a new distinct entity in the destination state, may and often does require the issuance of a new federal employer identification number, and can trigger serious federal tax nuances. That's a euphemism for problems. Finally, dissolution should not enter the conversation at all, because dissolution terminates the company. Dissolution is a going out of business mechanism, not a relocation mechanism. Dissolution is often a taxable event, and when performed incorrectly, can expose the owners of the company to unlimited personal, joint, and several liability for the company's liabilities, known and unknown. If you have a so-called professional suggesting dissolution as a relocation option, please seek better advice. Redomestication, when paired with a change of personal residency and this is an important a reduction or outright cessation of business operations in the former state, can reduce or even eliminate state tax exposure for the entity and its owners there. Don't take my word for it. Ask your CPA, and if you get a blank stare, maybe it's time to get a new CPA. Now is the time to consider acting before the California State House considers changes to the law to hinder or even eliminate the option of redomestication. And yes, California does currently allow redomestications of limited liability companies and corporations. If somebody is telling you otherwise, they are behind the curve. If you have questions regarding potentially redomesticating your existing LLC or corporation out of California or out of another state, please use the link in the description for more information on this process and to schedule time for you and I to speak one-on-one about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information illuminating. As always, the information in this presentation is necessarily general in nature and is not legal or tax advice, nor should it be construed as such, because that advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on these tantalizing and timely topics, there's some alliteration for you. Please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to that opportunity to speak and perhaps even work with you very soon.